Hello, investor. Welcome to our channel. For over 50 years, one question has been on the minds of those who invest in Berkshire Hathaway. What happens when Warren Buffett isn't here anymore? With the recent loss of his right-hand man, Charlie Munger, and Buffett announcing his retirement, that question is no longer just a theory. It's now the main question for the future of one of the world's biggest companies. Berkshire Hathaway is much more than just a stock portfolio. Even though its huge stakes in companies like Apple, American Express, and Coca-Cola get a lot of attention. It's actually a giant company with over 75 businesses, from railroads to insurance, and even energy and retail. But historically, the magic has always been in one man's amazing skill at putting money to work. So what happens when the leader leaves the stage? Will the orchestra keep playing in perfect harmony? Or will the music go off-key? Let's dive into the future of Berkshire Hathaway. We'll look at the company's biggest headache, a growing pile of cash. We'll break down the strength of its main businesses, which are the backbone of this empire. And most importantly, we'll explore how investment strategy might change under new leadership and what the real risks and opportunities are in this historic shift. Stay with me until the end, because this analysis is very important for anyone who owns or is thinking about owning BRK stock. Let's get started. The $320 billion cash dilemma. To understand Berkshire's main challenge today and in the future, we need to talk about money. A lot of money. At the end of 2024, the company had an impressive $321 billion in cash and cash equivalents on its balance sheet. After setting aside what's needed for operations, about $280 billion are left. It's a war chest that would make any country envious. Ironically, this financial fortress has become a headache. Buffett himself admitted the growing difficulty in finding big deals at reasonable prices. Berkshire has become so big that a $1 or $2 billion acquisition barely moves the needle. It needs elephants, and there are few elephants available in the market at prices that make sense for the company's value discipline. Recent history shows this. The company has struggled to invest this excess cash in projects that exceed its cost of capital. Big bets like the Kraft-Heinz merger and the acquisition of Precision Castparts didn't deliver the expected results. The result? Money piles up, earning little, especially in low-interest environments, and Berkshire's return on equity, though still solid, has fallen below the S&P 500 in the last decade. The big question post-Buffett will be, what to do with this mountain of money? Will the new management, led by Greg Abel, have Buffett's same patience? Or will we see a change in approach? Maybe more aggressive share buybacks? Or who knows, something Buffett has always avoided, paying dividends. This is, without a doubt, the main challenge and the biggest opportunity for the future Berkshire. The economic moat, the sum of the parts. If brilliant capital allocation was the soul of Berkshire, its operating businesses are the body, a strong and tough body. It's important to know that Berkshire isn't just a stock portfolio. It's a group of companies with strong competitive advantages, what we call an economic moat. Let's break it down into three big parts. First, the heart of the empire, insurance. Companies like Geico, the reinsurance company BHRG, and BHPG are the crown jewels. They create the famous float, which is the money from premiums that Berkshire gets early and can invest for its own benefit before paying out claims. Historically, thanks to great underwriting discipline, this float has cost nothing or even been negative. However, the insurance business is super competitive. It's a basic product. But Berkshire stands out. Geico has a huge cost advantage with its direct sales model. And the reinsurance arm, BHRG, has such a strong balance sheet that it can take on huge risks, like natural disasters, that few competitors can handle, letting it pretty much set its own prices. These operations are expected to make almost half of the company's profit in the coming years. The second part is the infrastructure giants. The BNSF Railway and Berkshire Hathaway Energy, BHE. Buying a railway was a smart move by Buffett. Why? Because it's a business with huge barriers to entry. Nobody is going to build a new railway system to compete. BNSF operates in a two-company market in most of its areas, which gives it huge power to set prices. It's like a toll booth for the American economy. BHE, on the other hand, is a group of regulated energy companies. Even though the profits are limited by regulators, they are super stable and easy to predict. Also, because it doesn't have to pay dividends to the parent company, BHE has been able to put billions back into renewable energy, much more than its competitors. Finally, we have the third part, a mixed bag of over 50 manufacturing, service, and retail companies. Here you find everything: Clayton Homes, prefabricated houses, Lubrizol, chemicals, Duracell, batteries. Buffett's idea has always been to buy companies with steady profits and strong management. Even though this part is less clear, it's believed that most of these companies have small competitive advantages that will keep bringing in cash steadily for many years, with or without Buffett. The new management, changes in capital allocation. Okay, the businesses are strong, but who will make the big investment decisions? The chosen successor is Greg Abel. He's not a clone of Warren Buffett. Abel comes from the operations side, having built the Berkshire Hathaway Energy empire. He's known for being a manager focused on efficiency and operations. So, what can we expect? The analysis suggests some important changes. First, it's unlikely that Abel will have the same aura as Buffett to secure unique and favorable deals, like the ones Buffett made during the 2008 crisis. The Buffett effect that opened doors and secured preferential terms might lessen. Second, the company might become more open to financial engineering. The new management might focus more on optimizing existing operations and unlocking value that might have been dormant under Buffett's more hands-off philosophy. This could mean more synergies between the group's companies. Third, and perhaps most important for shareholders, capital return. As long as Buffett is in charge, dividends are almost unthinkable. But after the change, the pressure to distribute some of the huge cash pile will be enormous. A modest quarterly dividend would be a huge change in Berkshire's culture and could attract a new type of investor. Besides dividends, we can expect a faster pace of share buybacks. In recent years, Berkshire has already bought back about $78 billion in shares, but not in a regular way. With shares trading at a price that the new management finds appealing, buybacks could become a much more aggressive and predictable tool to use cash and increase value per share. Risks and uncertainties of the transition. No analysis would be complete without talking about the risks. And the main one, of course, is the key person risk. Buffett's departure is an event the market has been watching for decades. His genius in evaluating businesses and market psychology isn't something you learn from a manual. There will be an undeniable loss of talent at the top. Another risk is the decentralized culture. Buffett fully trusted the managers of his subsidiaries, giving them complete freedom. Maintaining this culture of trust and meritocracy without Buffett's fatherly figure will be a challenge. Corporate bureaucracy might start to creep in. Also, Berkshire's corporate governance has always been a point of criticism. The board of directors, the unequal voting structure between Class A and B shares, and the lack of transparency in some areas are things modern investors, especially those focused on ESG, don't like. The new management might face more pressure to modernize in this area. Finally, there's the risk that, even with all the changes, the problem of size will remain. The law of large numbers is unforgiving. Generating extraordinary returns on nearly $1 trillion in capital is much harder than it was 30 years ago. Berkshire might become a solid and stable company, but with returns closer to the market average. Conclusion and investment thesis. So, let's tie all of this together. What can we expect from Berkshire Hathaway without Warren Buffett? On one hand, we have an extremely strong business body. A group of high-quality businesses with lasting economic moats that will keep making lots of money for decades. A balance sheet that's a true fortress, letting the company get through any hard times easily. This strong base won't disappear with Buffett. On the other hand, we have the unknown about the company's soul, how it uses its money. Buffett's genius for making extra returns with cash will probably be lost. The challenge of investing a huge amount of money in a way that makes a profit will become even bigger. The investment idea for Berkshire after Buffett changes. It stops being a bet on an investing genius and becomes a bet on a high-quality group of companies with a lot of money and the chance to unlock value by giving money back to shareholders in new ways, like dividends and buying back more shares. The company will probably become less amazing and maybe a bit more predictable. For some, this might be the end of the magic. For others, it could be the start of a new phase, more grown-up and focused on being efficient and giving money directly back to shareholders. The elephant of Omaha will keep dancing, but maybe with a different beat. And you? How do you see Berkshire's future? Do you think Greg Abel and the new team will be able to keep the legacy going? Or do you think the company's best days are behind it? Leave your thoughts here in the comments. Let's talk about this fascinating case. If this analysis helped you understand Berkshire's path better, Don't forget to hit the like button, because that helps us share our content with more investors. And of course, if you haven't subscribed yet, subscribe to the channel and hit the bell to not miss our next analyses. Thank you very much for joining me. A big hug and happy investing.